Something unbelievable just happened in the trade war. US markets plunged over 4% last week, wiping billions in hours. But now, out of nowhere, Trump is reaching out to Beijing, trying to calm the storm he created. His team, once confident they could pressure China, suddenly looks nervous. While Wall Street panicked, China stayed silent, watching, waiting, and tightening its grip on global supply chains. From rare earths to soybeans to batteries, Beijing holds the levers that keep American industries alive. And when you control what others need, you don't have to shout to win. The shift is already visible. Green candlesticks flicker back to life, and Trump's social posts sound less like strength and more like damage control. The trade war isn't over. It's entering a phase where power is measured not in threats, but in control of real-world production. China's leverage doesn't come from loud statements. It comes from quiet control over what the world depends on. Every advanced industry in America, from electric vehicles to fighter jets, relies on rare earths that mostly come from China. About 70% of all rare earth compounds used by US manufacturers are imported from Chinese mines and refineries. For certain metals like scandium, which is essential for lightweight alloys and missile-grade magnets, the dependence is complete, 100%. Even if Washington secured every ounce from Japan and Australia, prices would still skyrocket. When a country controls over 2/3 of global supply, you don't replace it with speeches or tariffs. Trump's goal is to rebuild high-tech production inside the US, chips, EVs, batteries. But those plans are decades behind. The US has only one operating rare earth mine, and most of its ore is still shipped to China for processing. That's the real choke point. Beijing spent years investing in refining technology, while America outsourced it. Now, when Trump raises tariffs on Chinese imports, he's effectively taxing the very materials American factories need to function. And this pressure is spreading fast. China isn't just the top supplier of rare earths. It dominates 90% of the global refining capacity. Without it, magnets for missiles, wind turbines, and even iPhones can't be produced at scale. That's why any disruption sends ripple effects through the entire industrial chain. Prices of neodymium and dysprosium already jumped more than 25% since the start of the year, squeezing profit margins in the US defense and tech sectors. This quiet control gives Beijing a shield against Washington's aggression. While the White House threatens, China simply tightens its grip on supply, knowing every new restriction hits America's own industries first. And that's just one part of the equation, because Beijing's next move targets something even closer to the US heartland. Markets have been on a roller coaster. After Trump's tariff threats sent global investors into panic, US stocks crashed more than 4% in a single week, the steepest drop since early 2023. Trillions of dollars in value were wiped out almost overnight. Bond yields spiked, commodities tumbled, and investors rushed to safe havens like gold and the yuan. But just days later, the markets rebounded sharply, with major indices turning green again. That sudden recovery didn't come from confidence. It came from fear inside the White House. Behind the scenes, Trump's advisors began to realize how fragile investor trust had become. Companies were halting orders, and analysts warned that another round of tariffs could push US manufacturing into a recession by year-end. J.D. Vance, one of Trump's closest political allies, unexpectedly called on Beijing to choose the path of reason. The message was clear. Washington wanted a way out without admitting defeat. Then came Trump's post that stunned even his supporters. Highly respected President Xi had a bad moment. He doesn't want depression for his country, and neither do I. The tone was almost conciliatory, a far cry from his usual fire. For Beijing, it confirmed what many already believed. The United States had lost control of the narrative. While Washington tried to calm the markets with words, Beijing focused on actions, tightening control over the real economy. And that's where the next shock was already building, in America's own farmlands. China's retaliation didn't start in tech or industry. It began on America's farms. In September 2025, Beijing quietly rewrote the trade map. Chinese soybean imports hit nearly 13 million tons for the month, a new record, and not a single grain came from the United States. Instead, Brazil filled almost 80% of those orders, with Argentina supplying most of the rest. What used to be a steady pipeline of American soy flowing into Chinese ports has now been replaced by long-term contracts across Latin America, where China is also building railways, silos, and new trade hubs. This isn't the first time Washington has faced such a blow. During the first trade war in 2018 to 2019, China's soy purchases from the U.S. collapsed to barely 2 to 3 million tons in total, forcing Trump to issue a massive $28 billion bailout to keep farmers afloat. But what was once a temporary shock has now turned into a full cutoff. In 2025, Chinese imports from the U.S. have fallen to zero, a complete freeze that could last for years as Beijing deepens ties with Latin suppliers. The effect on U.S. farmers was immediate. Soy prices plunged below production costs, turning profits into losses. According to the USDA, average losses now exceed $110 per acre for soybeans and $400 per acre for cotton. Even corn and wheat are barely breaking even. At the same time, farm debt is at its highest level in more than a decade, exceeding $540 billion nationwide. Interest payments alone reached $33 billion this year, roughly 7% of total farm expenses. When borrowing becomes this expensive, small and mid-sized farms have no buffer left. Now analysts warn the next bailout could easily double or even triple the 2018 package, pouring tens of billions more into an already strained federal budget. Every new round of aid adds weight to America's $37 trillion debt pile, a burden future taxpayers will carry long after the tariffs fade. China, meanwhile, keeps deepening its roots in Latin America, turning former U.S. markets into allies. For Washington, this isn't just lost revenue, it's lost influence. And as American farmers struggle to stay afloat, another storm is already brewing in manufacturing, where tariffs and high costs threaten to hit just as hard. Tariffs were supposed to protect American jobs, but they've turned into a trap that's hurting nearly every sector. When duties rise, the price of everything tied to production rises with them, from imported tractors and fertilizer to basic machinery parts. Farmers now pay 20 to 25% more for equipment than they did just 3 years ago. Manufacturing costs for steel and aluminum components have surged again since Trump's 100% tariff threat on Chinese goods, pushing small factories to the brink. For the government, every new tariff brings short-term revenue but long-term pain. To offset losses in farming and industry, Washington has to spend more, through bailouts, subsidies, and tax breaks. The result is a deeper deficit. The Congressional Budget Office now expects the U.S. to borrow over $1.8 trillion this fiscal year, adding to a national debt already past $37 trillion. The interest payments alone exceed $1 trillion annually, money that no longer goes to infrastructure or public services. At the same time, inflation refuses to disappear. Tariffs keep import prices high, and the Federal Reserve's rate cuts can't fix supply problems created by trade restrictions. U.S. producers are squeezed from both sides, rising costs and shrinking demand. Big corporations can shift production abroad, but smaller firms can't survive that hit. The irony is clear. Policies meant to make America self-reliant are driving its industries toward higher debt and lower competitiveness. And while the White House struggles to balance these contradictions, Beijing is quietly tightening its grip on something even more critical: the future of global energy and technology. China has now opened a new front in the trade war: batteries. After dominating rare earths and agriculture, Beijing has moved to protect its crown jewel, the lithium-ion supply chain. This year, China introduced new export controls on advanced battery materials and manufacturing equipment, including cathode and anode technologies used in electric vehicles. The goal is simple: keep innovation inside China and make it nearly impossible for the G7 to build alternatives fast enough. Today, around 80 to 90% of global cathodes, anodes, and electrolyte components are produced or refined in China. The country also controls over 60% of global lithium refining capacity and more than 70% of cobalt processing. Without these materials, battery costs soar. South Korea, Japan, and Europe can't fill the gap, and Trump's tariffs now make it even harder for American firms to import from them. If China decides to further restrict exports, the entire US EV transition could freeze overnight. Already, US automakers are falling behind. BYD, China's biggest EV producer, delivered 580,000 vehicles in the third quarter of 2025, compared to Tesla's 500,000. And while Tesla plans new gigafactories, China has over 200 battery plants either operational or under construction. Beijing's dominance isn't just about low costs. It's about speed, logistics, and control over every step, from lithium mines in Africa to finished battery cells shipped worldwide. If the US tries to build its own supply chain, it will take at least a decade and cost trillions. Meanwhile, China can weaponize time itself, keeping prices stable at home while US industries drown in costs. And that's where the trade war reaches its breaking point, when Washington realizes that tariffs can't fix a system where China already owns the foundation. Trump still insists the United States is holding the stronger hand. He praises Xi Jinping in interviews, calling him a great leader and claiming their relationship is solid, a sign that he's trying to project confidence as markets wobble. But beneath that optimism, every card he's played has started to turn against him. The tariffs meant to punish China have pushed up costs for American consumers. The strong dollar, once a weapon, has driven allies toward alternatives and accelerated global de-dollarization. Even the farm bailouts meant to protect rural America have deepened the national debt, now well past $37 trillion. Behind the speeches and social posts, investors see the cracks forming. Interest payments alone are nearing $1 trillion a year, and US manufacturing output has fallen for 3 consecutive quarters. Washington keeps juggling inflation, deficits, and fading global trust, like a Jenga tower swaying under its own weight. Trump's latest tariff threats may sound bold, but they expose the same weakness China has exploited for years: America's dependence on debt and fragile supply chains. While Washington talks about victory, Beijing keeps building, and the world is quietly deciding which system looks more stable. This trade war has made one thing clear: power today comes from production, not slogans. China spent decades building that strength, while the US is trying to rebuild it overnight. The cracks are now impossible to hide: rising debt, broken supply chains, and a leadership trapped between pride and reality. The next move will decide everything. Will China tighten its grip with new export bans, or will Trump step back from his 100% tariff threat? Let me know what you think in the comments, and don't forget to like and subscribe as we follow this global shift together.